structure for the employees at the CIO incentivized risky behavior that led to the massive trading loss instead of rewarding those who reduced the bank's risks? Were there bonuses for generating profits out of the CIO? Will you seek clawbacks from traders, management, and executives involved in this trading debacle?
So I think, let me just give a big picture about compensation at J.P. Morgan. To start with, we don't, and have not had for 5 or 6 years, special severance packages for executives, change of control, parachutes. There was no one in CIO who was paid on a formula. The management of the CIO portfolio was subordinated to the rest of the company. They were not allowed to do what they want. They couldn't invest very long. They couldn't take too much high-yield exposure, et cetera. They were paid for what they did for the whole company. And when we pay people, everyone, we look at their performance, the unit's performance, the company's performance, and their performance includes recruiting, training, integrity, sharing with senior management, all the things that we need to do to make it a better company. So I don't believe that the compensation made this problem worse, and like I said, none of these folks were paid on formula. Oh, your second question was clawbacks. When the board finishes a review, which I think is the appropriate time to actually make those final decisions, I think it would be inappropriate to make those decisions before you finish your final review, you can expect that we'll take proper corrective action, and I would say it's likely, though this is subject to board, but it's likely it'll be clawbacks.
Senator Shelby.
Thank you, Mr. Chairman. Mr. Dimon, so that we would have some idea of what happened, could you explain?
You can see there, that is J.P. Morgan CEO Jamie Dimon down in Washington, D.C., answering questions about the big London whale trading losses. What does it mean for J.P. Morgan? What does it mean for banking regulation? All those questions are, we hope, being answered. Good morning, everyone. Welcome to the Markets Hub. I am Paul Vigna, joined to talk about this story. This is the big story of the day by Greg Zuckerman, who is been running around covering this thing. We've got, we must have at least half a dozen reporters on this story. Clearly the big story today. Tell me, in the short time, it started at 10 a.m., have we learned anything new so far?
Not yet. There's that circus that always begins with these things, and usually I find it a little more interesting later on when he kind of is tired and has to be a little more revealing, perhaps.
Right.
So hopefully we will. But we thought he would come into this thing talking about how he was hedging, and that's what they're talking about right now. Whether it's the way you and I define hedging is, a different issue.
Right. Now, we had his testimony last night. It was up on the Deal Journal blog, and Deal Journal, actually, they're live blogging it. So after this show, everybody go to Deal Journal. Don't go there yet. But so we had his testimony last night. We knew what he was going to say. We know what his stance is going to be. He's obviously said, look, this was a huge mistake for the company. We were wrong, all those things. But doesn't necessarily mean that, regulators should have, regulators should just be allowed to do whatever they want, go whole hog in terms of telling the banks what to do. Is this hearing today going to be, is this really going to be a circus, or does this really mean something in terms of how the banks are regulated? We know Dodd-Frank's been passed. They're still working out the details. Is this hearing going to make any change in that?
It will mean something if they have a different interpretation of the Volcker rule than we had expected just a few weeks ago. And it could, so it'll be a little more stringent. The Volcker rule will impede banks from trading with their own capital. And banks need to do that. You can't just say, oh, banks can't trade with their capital. When you're, especially in the debt markets, a lot of the liquid stuff gets traded there, you have to take positions. So they're going to have to take positions and use their own capital. But because of this incident, the London whale incident, the interpretation of the Volcker rule might be very different. So that's what I'm looking forward to seeing what happens.
Yeah. And this really raises the issue of, were these, you mentioned it, right, the definition of hedges. Were these really hedges, or was this aggressive trading more on the lines of what a hedge fund might do?
Yeah.
More on the lines of what a real investment bank might do? And should those types of activities carry a government protection? That's the real issue, right?
Yeah, these activities, they would argue, don't have a government protection because they're not using the depositors' money. You and I would say, well, okay, but if J.P. Morgan goes under, we know that the country's going to have to bail them out. Right. So because they are the definition of too big to fail. So that to me is the issue. And they, in their mind, might not think this was a proprietary bet hedge fund-like bet, but you and I can really look at it as if it was.
Right, and Dimon has said several times, I believe, that taxpayer money is not at risk here. This isn't that kind of a situation. 2 billion loss, it's a huge number, but this is a gigantic bank. We understand all that. Doesn't make it right.
I don't know about right or wrong. The question is whether it's risky or not, and
Well,
whether you and I want to have to backstop them. If
That's the
if
right,
something
not right or
happens.
wrong. Should government, should taxpayers be backstopping this kind of activity? Because even if we're not affected by this one right now, you and I, we are backstopping these banks. I mean, there are government guarantees that allow the banks to make a bet like that.
I mean, you can make an argument that J.P. Morgan's alternative is just to buy treasuries, and treasuries are kind of dangerous here at 10-year at 1.6%. So they would argue that, hey, we're buying stuff that's actually just as risky as a treasury. I would counter by saying they were the biggest player in a liquid derivative instrument that cannot be very safe. So they got a little bit carried away.